Joining us for this one. Josh Lawler is an expert in a lot of different things. I'm going to let him do the intro. I don't want to steal your thunder like I did with the bad crypto guys. I told basically everything they were going to promote. No, I'm kidding. Tokenized income sharing agreement. So this is really interesting, somewhat complex, but Josh has a really good way of breaking it down and helping the layman to understand the implications of this stuff. He was on some panels yesterday, so I really appreciate the support, Josh, and really looking forward to hearing this deep dive.
Okay, great. So let me just make sure that PowerPoint is here. Yep, that should do it. Okay, wonderful. All right, so thank you for that introduction, Jeremy. I am Josh Lawler.
Just share your screen.
I'm sorry?
If you could just share your screen, we can.
Oh, sorry, right. Okay, thank you for that. Blah, 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 blah. How are we doing on that one? Is that working for you?
All right, take it away.
Okay, great. So, as mentioned, I am Josh Lawler. I am a partner at the law firm Zuber Lawler, where I head our new technologies group. And I practice securities and intellectual property law and do commercial law as well. I've been practicing for about 25 years, and obviously distributed ledger technology hasn't been with us nearly that long, but I'm fortunate in that I've got a real mental itch for the topic and a passion for it. And I gave a version of the tokenized income sharing agreement talk in Miami, and I just launched right into my my PowerPoint there, which is, you know, a typical lawyer boring PowerPoint. And I found I had a few people's eyes glaze over. So I'm going to do a little bit more background here first. And hopefully I'm not telling everybody anything that they already know, but, you know, if so, well, so be it. So, you know, the first thing I want to mention is that the securities laws in the United States don't really work so well for digital ledger technology and for cryptocurrency, obviously. It is, as a lead into the tokenized income sharing agreement, I kind of want to give you the story of why, so that you can appreciate the problem that we're looking to solve. If you look at kind of the history of cryptocurrency, you know, after you've got, you know, Bitcoin and, you know, Silk Road and all that kind of stuff, and you get into the altcoins and the ICO craze, what you're going to find is that, you know, the initial impetus is that software engineers were raising money without needing to raise money. And that's to be expected, which is to say that if you were previously somebody with a software company startup and you needed to raise money, it's a royal pain in the butt. You have to comply with securities laws. You have to go and, you know, walk it around to all the seed investors and angels and venture capitalists, and it takes forever. And, you know, I've been doing this for a long time, so I've heard a lot of people really complain about the process, and there's nothing that I could say that would be telling them they're wrong. It was a pain. So somebody figures out, Vitalik, that they can basically raise money by selling tokens that are going to be important in a future system. And I'm sure it felt very much like Kickstarter or Indiegogo at the time. And the tokens are products. And the reason somebody would buy these is because they're going to work in the system. And it was a short hop from that to the idea that, you know, because of this supply and demand dynamic and because people were speculating, that they could sell anything. And they could sell it really fast. And from that point, you had a lot of people who fit the category of profiteer more than software engineer jump in with all kinds of projects. And, you know, we all know how many shitcoins there are out there. So as this is happening, you've got, you know, in the United States, a lot of people, as usual, who aren't in the know, who try to jump on the get rich quick scheme. And the result of that was that a lot of people not in the know got absolutely abused. And they got abused in the way that the securities laws are designed to prevent. So the SEC is watching this. They have their twin mandate of preserve orderly markets and protect the Main Street investor. And the Main Street investor is getting killed. Now, were they getting killed by a sale of securities? Hard to say, really. However, nobody else was jumping in to help them out. You know, my own preference would have been that the Federal Trade Commission got involved, but they didn't really, maybe a little. So the SEC comes out and they use the Howey test and they crowbar tokens into the definition of investment contract. And for a variety of reasons I'm not going to go into on this panel, this breakout, it doesn't really fit and it doesn't really work. However, we are stuck with it, no question. And for anybody who is watching the Telegram saga, and Telegram just, I think it was today, announced that they will be paying the SEC $18 million or so to settle their issues. But Telegram is very important because Telegram tried to do it right. They hired my old law firm, Skadden Arps, very expensive, very experienced, very good law firm. And they did their offering. And then they had Skadden Arps defend them in their, their SEC action. And the SEC, quite frankly, or the judge, I should say, quite frankly, in my view, broke a few really key rules that mess up the entire securities industry, but nonetheless have locked in the idea that, in the United States, if you're going to do a token offering and it resembles a financial product, including via supply and demand, that you're going to need to comply with the securities laws. And while I don't begrudge the SEC how they got there, there's a great place for regulation. It has unfortunately left us in a very bad position globally in terms of innovation and in terms of what I think is going to be, a really extreme revolution into distributed ledger technology. So let's talk about that extreme shift for a second. I've been asked many times whether how one regulates digital assets, and I tend to think that it's a somewhat ridiculous question because you might as well ask me how you regulate paper. If you think about it, all a digital asset is something that's recorded on electrons, software code. There is no difference between that and a piece of paper. There is no difference between that and a clay tablet in terms of regulating what is on those things. So, there's a lot of variety here. You can't really lump things together. What has changed dramatically is the idea of a centralized ledger versus decentralized. And if you look at the dawn of human existence, you're going to find that the guy in a cave who's keeping track of the mammoth steaks and the nuts and berries is a centralized ledger. That's what it is. He knows how many mammoth steaks and what the nuts and berries are, who brought who to what and who gets what. Is a centralized ledger. And if you go from there up to 2008, mostly there's some argument about before 2008, but up to 2008, everything is centralized ledgers. And all of our financial systems, all of our government, all of our religion, all of our socioeconomic class structures, literally everything has been based on centralized ledgers. And it takes a little while thinking about that to really understand how big of a statement that actually is. It's almost like saying that, beehives are based on honeycombs, and like, what would it be if a hive had an option to do something else? What would that look like? And it's rather amazing to think about, but that paradigm can now shift to a distributed paradigm where you don't need trusted intermediaries for everything. You don't have the ability of certain entities and organizations to monopolize data and exert control from that perspective, which scares the heck out of the governments and the central banks. It's a massive shift. And I'm certainly not advocating for a full shift to distributed ledger tech. There's definitely a place for regulation and for government. But I think in order to appreciate what I'm about to go into, you have to really understand that scale. So hopefully that explained it all. All right, so with that kind of behind us, let's talk about securities for a second. So generally speaking, they fall into a few categories, and the investment contract that you know from Howie is kind of the great catch-all for anything that's not in these categories. But you're, I'm sure, familiar with stock, equity. You're familiar with debt, that's bonds. You've got this whole world of derivatives. And derivatives are important because derivatives are contracts, and they're very structured, but that can be anything from pooling mortgages and income from mortgages. That's our infamous collateralized debt obligations that caused the 2008 crash. It can be pools of different stocks and, ETFs fall into that category. Mutual funds fall into that category. It can be futures contracts for commodities. So, you've got spot markets, which is the actual commodity you're buying. And then there's paper commodities. And oftentimes in many commodity markets, there's more paper than there is actual commodities, silver being a great example of that. And then you've got the investment contract. And the investment contract is, defined by, the court in Howey in 1946 to basically be a situation where, somebody who is running an organization sells some kind of an interest in that organization for, to avoid breaking out the entire Howey test. And that oftentimes can be looked at as kind of a royalty. And notably, the income sharing agreement fits into that category. So about the income sharing agreement, it has been up to now a really, really horrible financial product. It is not a good investment. And the reason it's not a good investment is because it's not typically diversified. You're usually talking about a single income stream. And it's also illiquid. And to give you some examples of that, every year I get pitched by my law school alma mater, Northwestern, if I would like to enter into an income sharing agreement to finance the tuition for, a promising student. And were I to do that, I'm pretty much stuck with that investment, and I'm hoping that that student does well and gets a good job and is able to pay me some, percentage back, but I don't really know that. And there's certainly nobody who's looking to take that income sharing agreement off of my hands. There's no marketplace for it. Even if there was, how would anybody ever trade it? It's a horrible, horrible investment. However, if you turn it into the route of a tokenized contract, it can turn into a really, really good investment. So we're going to get to that in a second. Before we do, again, you'll humor me. I want to talk a little bit about our current securities kind of trading and secondary trading system and what goes on under the hood that allows things to be traded. And the reason I want to do that is because it helps illustrate the inefficiencies in the current situation. And, when you look at that, the thing you need to keep in mind is that it's all because these are written on paper, or at least historically have been written on paper. If you go back to, 1950, whatever, or 40, whatever, a share of stock is a piece of paper, period. Now, in our day and age, that's not necessarily always true. However, we still treat it as if it is. So if I am a company and I am going to be public and traded and I issue stock or I issue bonds or really anything else that's going to be a liquid security, I am going to take my certificate, my paper certificate, and I'm going to send it to a organization called DTCC, which stands for the Depository Trust and Clearing Company. And DTCC is actually a co-op of, I think it's 27 different banks who realized that they had this issue way back when and put DTCC together. And if you were to look, you would find that last year, the stat on their website is that they processed roughly $2.15 quadrillion worth of transactions last year. And, you think about that. Our government is issuing trillions, and it's a large piece of the money supply in terms of, COVID-19 relief. We are talking quadrillions. That's kind of insane. And what DTCC does, metaphorically, no longer actually the case, but, they've got a file room, and they stick these stock certificates in a file room. And they have arrangements with correspondent regulated institutions that have accounts with DTCC. And those would be places like, Fidelity or Schwab or, I'm sure Morgan Stanley and Goldman have theirs, those types of places. Now those places then who are registered broker dealers, they in turn, that's called holding in street name. That's who has this thing for the record. They in turn have sub-accounts for different of their customers, and their customers may have sub-accounts and more sub-accounts and more sub-accounts, all the way till you get to the final owner, who's called beneficial owner of a security. So very complicated, and the people who are the beneficial owners, you know, they're not holding their securities, they're holding rights to an account, to an account, to an account, to an account. And if that sounds familiar, that's, you know, something, the beginnings of how a centralized cryptocurrency exchange works. Also, you know, you have your exchange at Coinbase. Coinbase has all the tokens in, you know, their storage, and just keeps a record of who has what. You're not actually holding your coins in an account. So that's the basic setup. Now, if you want to trade a security, then depending on what's going on, the catch is that things have to run all the way up that chain so that DTCC can, you know, make the right notation in terms of who's got what account. And there's a transfer agent involved. There's a concept called custody involved. There's a concept called clearing and settlement involved. And the short version is that it takes a few days. You know, T+3 is actually kind of the known time for clearing certain types of trades. And, you know, stating the obvious, it's a lot faster to do a trade on a blockchain. I mean, even Bitcoin moves faster than 3 days. So, you know, there's that. And then the other piece is that every single step of the way is an opportunity for somebody to collect a transaction fee. So you've got time and you've got expense. And none of that stuff is, at least in my mind, necessary for trading digital assets. You know, the fact of the matter is you don't need the centralized ledger. There goes DTCC. You don't really need custody. They're digital assets. You might still have custody in certain circumstances, but you don't need it. You don't really need a transfer agent when you've got an immutable, transparent blockchain that anybody who wants to can look at. And, you know, accordingly, I don't think you really need all the fees either. So that's kind of the preamble to the income sharing agreement. And that took me 15 minutes. So thank you for bearing with me on that. We're now going to jump into the PowerPoint. So that's me again. I'm Josh Lawler at Zuber Lawler. Based on that last discussion, you probably have a pretty good idea what it is that I do. So let's talk about the tokenized income sharing agreements and its benefits. And I like to call this the TISA, because it's TISA. I will say up front that we do have a side project based on these things that hopefully you'll be seeing more of in the coming months. And a lot of what I would have going in that project, I can't say because it's all confidential, but we can talk about the advantages of tokenized income sharing agreement. So what are those advantages? Well, as I just mentioned, they are fully automated, or they can be fully automated. If I want to trade a digital asset, I can do so on a peer-to-peer basis. Now, there may not be a market for that, but, you know, if I want to trade my Northwestern law student's income to Jeremy Bourne, because the sucker's born every minute, sorry, Jeremy, I can do that, and he can buy it, and it's just a question of the transfer. That can also happen through a bulletin board like a DEX. It can happen through a centralized exchange like Coinbase or Kraken or whomever. It can happen through our legacy systems like NASDAQ Capital Markets or the Canadian Stock Exchange, who are both very forward-thinking. That's not going to happen instantaneously for other regulatory reasons, but theoretically it could. So that's pretty huge. The other place that they're fully automated or can be fully automated that is really amazing is, you know, from an income perspective, these are income sharing agreements. The idea is that you're paying something up front for a continuing string of income. Now, that may feel a little bit like a dividend or interest that, you know, you'd make off of a bond or a share of stock. It's not taxed the same way, notably. But the thing about it is, if you think about the dividend process, it's complicated. You've got a record date, which is, you know, who gets the dividend has to be holding a share at a particular date. You then have a distribution date. And, you know, the funds all need to be wired through the entire chain that I just discussed. So, you know, I won't go into the whole process, but there's the nominal owners that DTCC has, and then it goes all the way down the chain. You get the idea. With a tokenized income sharing agreement, you don't really need all of that. You need the income to hit a bank account, and then preferably through some type of an oracle, like a chain link, for instance, had to give the shout out, that can then trigger a stablecoin payment to whomever happens to be holding the tokens at the time. And the only thing that I've found so far that's in the way of that automation is transaction costs for the chain. So if you've got a micro payment, the transaction cost for that might be enough that it doesn't make it worth it. So possibly you have to wait till there's some minimum distribution. But the point is, it can be automated. Now, the other thing that can be automated there is the record keeping. And we'll get to this from a tax reporting perspective later, but as you are making those payments, that can be recorded. So you know who you paid, how much, at what time, because as your TISA tokens move, people are going to be entitled to payments at whenever they're holding it, but then they might sell it. So over time, it creates a lot of data. The income sharing agreement is flexible. It's super flexible. If there is a revenue stream, I can make an income sharing agreement out of it, and I can tokenize it. And this gets to that question about, how do you regulate digital assets? Well, how do you regulate paper? The fact is that this can be anything from Spencer Dinwiddie's NBA contract and his guaranteed payments, which he ultimately did tokenize, albeit in a somewhat legacy type of way, not the way he initially wanted to. It can be a stream of profits from a cryptocurrency miner. It can be a stream of profits from the graduating class of Juilliard so that they can buy their instruments on graduation. And then over the next 5 years, you get 15% of all of their income, and that's all directed. It can be dividends off a share of stock. It can be DeFi. It can be interest off of a bond. There literally is no end to how you can draw up a contract that can simulate, the tokenization of any income stream that you want. And if you think about that, it's super attractive because it opens up capital raising to whole categories of people who otherwise don't have what would be a standard type of security or business model that would allow them to do this type of thing. It goes without saying that as tokens, these are fungible. So, for any series of TISAs, if you will, so for instance, if CoinGenius raises $3 million and, in exchange for that over the next 5 years is paying 10% of CoinGenius's net profits, all of those CoinGenius tokens in that series, just like any share of stock, any bond, they're the same. It's, a fungible token. They are fractional, and this is a really big deal, and it's huge in the real estate context. But because Bitcoin, for instance, will fractionalize to 18 decimal places. If I have my tokenized income sharing agreement, and because I want to be securities compliant, let's say that initially I issue those, $100,000 capital investment per token, which is not unusual for kind of a private securities deal. Once those things can be traded in secondary market, they can fractionalize out to however many decimal places. And therefore, once from a securities law perspective, it's legal to do so, people can invest in, and they might buy, 1/100th of that $100,000 token. And, you guys, again, are familiar with the way digital assets work, so that's not too hard. And that gets us to our next point, which is to say that it's kind of familiar for anyone once they're familiar with digital assets and tokens. There's no real magic to this. And that's not to say that they can't be complicated, because as I mentioned, the contracts themselves can be anything that we kind of imagine. But in terms of the trading of them, you don't need the whole broker-dealer kind of dynamic that's available right now through the whole chain of DTCC and everything under it that I described. It can be done on a peer-to-peer basis. Jeremy, if he decides that CoinGenius is doing really well, can go out and he can rebuy on a peer-to-peer basis those tokens from anybody who sold them to him. And that's a very basic example. And then they're fully visible. And this is the whole kind of transparent, immutable blockchain piece of it, you can see what wallets transacted every transaction. Anybody can see it. That makes auditing much easier. It makes for, you know, a much more trusting type of system. You know, if you're an investor and you can look and see, okay, income is coming from the income source, it's hitting a bank account, it's being automatically pushed from an oracle to whoever is holding the token, and you can verify who is holding the token at the time. That's, you know, a lot easier for people to keep track of than the current system, which is, you know, a bit Byzantine. Okay, so that's actually taking us to the next slide. So the key here is complying with the existing securities laws. We are not going to be able to get the regulators in the United States to be forward thinking and change the law to what we think it should be. They are going to need us to lead them in order to do that. And there's a variety of reasons for that, none of which makes anybody a bad person. It has to do with, you know, our political system, how laws are created. It has to do with the fact that the mandates for the SEC don't automatically include innovation. They include protecting the Main Street investor and the order of capital markets, none of which require them to change the law on this. Hence, you know, the attraction to trying to crowbar everything into current established protocols. So right here, I've got kind of a progression of securities offerings, and this is a little bit more esoteric to, you know, people who are securities attorneys or in the industry, and this is why the people in Miami's eyes glazed over, because I didn't give them that lead up. The 506c private offering, this is what you tend to think of as a private placement. It was made a bit easier than it had been by the Jobs Act. It's, you know, if you've heard of the term accredited investor, all this means is that you are selling your securities to accredited investors who are buying for their own account. That's the gist of it. They're not buying to resell it to somebody else, which is actually how Telegram was corralled. They are just buying it for their own account. And yeah, someday they may want to resell it, or possibly it's the type of security that has an expiration date. But that's the most basic item. And if you were to come to me right now as an issuer of a token, and we were to do an analysis and determine that it in fact fit into the definition of a security, this is what we would have you do. And there might be a private placement memorandum involved and all that other kind of stuff. And it's, you know, a little bit more expensive and time consuming than you want it to be, but that's what it is. This next item, Regulation S, which is also often done at the same time, that's a sale that's overseas. So the way US jurisdiction works, they say, look, if you're not selling this to US persons, then we don't really need to regulate it. Got somebody connecting to audio here. And that's pretty much the way the government has that. And that can be done at the same time. But the catch is you have to have restrictions on those securities then so that they don't flow back into the United States. That's the catch on that one. And again, that's a little bit how Telegram got caught. And typically you're looking for a year before those can become less restricted. And that's what we have now. If I were to do an offering of tokenized tokens that represent an income sharing agreement, I'd use one or both of those exemptions. The next item we've got is Regulation A, Tier 2. And Reg A, Tier 2 is really, really awesome. This is kind of the holy grail. Christina just smiled, so she agrees. You know, you can, for up to $50 million right now, and they may raise it to 75, do an offering to anyone, not just accredited investors, of unrestricted securities. And there's some accounting reporting tied to that. But the other thing tied to that is the fact that the SEC has to qualify your disclosure document. And that has been a real obstacle in token world. And for a long time, they hadn't qualified any of them. And in fact, usually this is a 4-month process. And amazingly, the token applications just kind of sat there literally for a couple of years now. Eventually, Blockstack did get one through. They, according to them, spent a 7-digit number to do that. This ordinarily should not cost anything close to that. But where I'm getting to here is that tokens in an income sharing agreement, which are readily understandable, easily auditable, my expectation, and I haven't talked to them about this, but I think it's the case, is that the SEC is actually going to love these because it's very easy to track compliance with restrictions. It's very easy to understand whether or not somebody's doing the right financial reporting, which all leads us to S1. Do I have to go? Am I getting told?
Yeah, that was your cue. Last 30 seconds, and then we're going to turn it over.
All right, last few seconds. All right, so S1, S3 is a shelf registration statement. The ultimate goal is to have like $50 billion on a shelf and to be able to rip these things off quickly and easily. Then there's secondary sales through markets, and the idea here is to actually have a liquid trading market so that any of these tokenized income sharing agreements can be traded like stocks or bonds, and for that you need to do Exchange Act reporting, which in this case really ought to be relatively easy because it's just an income statement. It's not part of a company, so there's no balance sheet or statement of cash flows involved. And then you've got tax reporting, which hopefully we automate, and there's a few companies, TaxBit being one that I like a lot, that can do that, which leads us to the company to keep an eye out for in a couple months called SIARC, which stands for Smart Contract Issue Administration Reporting Company, and we hope to take over the world. And that is all I have to say about that because I don't have any more time.
Thank you so much.
Thank you, Mr. Lawler.
If anyone wants to get a hold of Mr. Josh Lawler and the folks over at CoinGenius Collective Intelligence sponsors Zuber, Lawler, and Del Duca, Josh, where would they find you?
They would find me at J Lawler, the letter J, Lawler, at zuberlawler.com. And we're very, very, very easy to find. So just Google Zuber Lawler, it'll take you right to us.
Josh, thank you again to you and the firm for sponsoring. And I will just make a little plug here. We've worked with a lot of different firms before and gotten advice here and there. And there's no other firm that we found specifically that really truly does have the industry expertise as it relates to, securities law and different things like that, especially in digital assets. Josh really knows this stuff. He speaks all over the place. He's at every conference, especially ours, of course. But yeah, if you ever just want to ping him and ask him a question, I mean, he's pretty awesome at getting back to people, especially on LinkedIn. He posts a lot of great content there about all the relevant topics that are happening. So anyway, with that said, thank you again, Josh. Appreciate it.